Hey everybody, welcome back to Covered Calls and Short Puts. My name is Mike Fairborn, and welcome to our webcast. Looking today about discussing specifically finding maybe some of those stocks out there within the S&P 500 that are, obviously optionable. They have some liquidity behind them, but using the stock hacker to kind of isolate a couple of areas that might point us in a direction where we might just see higher implied volatility or higher movement potential, as well as we look at maybe some short puts today. We can also look at covered calls, but namely I wanted to look at short puts, setting up kind of with the market scenario. So look forward to going through that with you all. And by the way, I hope you had a good weekend. Let's see, we are joined in the chat by Randy, TM, Krishna, Eleanor, Will, and the usual suspects says Will. That's right. Good to have you here. We've got Rand. I said Randy. We got two Randys. We've got three Randys. All right. Randy times three. Well, welcome to all three Randys. Welcome to all of you folks. If you are new, let us know in the discussion. Just let us know in the chat that you are new. Would love to welcome you on board. We do have the always fantastic Barb Armstrong, a good friend of mine, in the chat. Does a great job in her classes. I encourage you to take a look at what she has. She has getting started with, well, options and other classes, but some of those are going to be changing upcoming. So correct me if I'm wrong there, Barb, but a lot of really good getting started material. Also, she has one that she does go through and takes another look at some of, like, well, she'll look at cover calls and short puts as well, but she might also look at verticals in addition to those short puts, adding in a long leg. So encourage you to take a look at what Barb's got, but it is nice to have you all here. And I think we're all set. Excellent. Good to have you. Sharon, Lisa at Mighty Mouse joining us. Let's hit some disclosures to get the show going here. All right. Options do carry a high level of risk. They're not suitable for all investors. Now, information here is for general information purposes only. Should not be considered an individualized recommendation or endorsement of any particular security chart pattern or investment strategy. Now, investing does involve risk, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the end of money amount. An ITM option has a higher risk of being assigned early. Talk about that in a little bit more detail here in a moment. Paper money software application is for education purposes only. And our next slide will tell us that if we do look at it, there are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends altogether. So, all right, let's get started. Let's get going, and good to have those of you just joining us. Riceburg, welcome. I do understand that Riceburg and a few of you were at that event. It was good to put a face to the name. Always good to do that, and welcome to you and all of the trading peeps, as Riceburg says. Excellent. All right, well, let's do this. Hey, I wanted to take a look. Well, let's do this. First off, we are going to look at the markets here. Let's look at the S&P 500 index first. Should have just clicked on it right there, but there you have it. Close it, trading up right towards that upper range, as you can see over here on the right-hand side of the screen. We do have that upper linear regression channel. Those of you that are not familiar with this is a channel that can be used if you are trading near all-time highs. It can give us a bit of, you could say, an estimation or an indication of a resistance level. Let me show you that right here. Let's see, it's just linear regression. I use the channel 50 here, and I'm just going to highlight it and kind of show you how close those lines are. This just plots simply correlations between price and time, and then put standard deviations above it or below it. You can see we've been on a nice long, upward diagonally sloping to the upside trajectory here. The reason why this can be helpful, I've kind of drawn in some of my own lines as well. I think they give good estimates, the linear regression. But if you draw those upper channel lines, they can be helpful for giving us indications and really insights as to where prices might begin to show some resistance. We might as well just label that with an R. Resistance, 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 and perhaps resistance over here as we approach the end of the year. We shall see. But it could be an area. Now, sometimes you break right above it, but it can be an area to kind of keep eyes on as you look at this going forward. Looking at the RSI, still showing, some upward trajectory, holding above the 50 level, which has been noted for just general strength in the market as well. And as you can see that. So really seeing some strength there, maybe heading up higher. A lot of times with that, the short puts can be of interest too, because with the short put, let's just clear off our chart for just a moment. It's always a nice drawing background. But a lot of times if the trend is up and we're looking at a pullback here for the possibility of a bounce trade, a bounce, which would also be, well, bullish, bouncing and potentially bullish in the direction of the trend, right? That sometimes those short puts, I'll just label those in yellow over here, they can be interesting areas because, hey, you might have, a prior high at this level where it's bouncing, maybe it's starting the direction of the trend going higher. But let's just say, for example, at, this level, there could be, well, support, as we said. But if we are neutral to bullish, that is the short put. That's where the short put really shines. Maybe we don't have a huge expectation that there might be a strong follow-through rally right to the upside. We don't know that, but we think it might at least be somewhat moderate to the upside, or even, maybe down even a little bit, but certainly possibly sideways in a channel, matching that neutral aspect that we spoke about, neutral to bullish. If all of those three scenarios fit together, and let's just put a big blue circle around a general area of where prices could move over a given time frame, over a different contract month. Let's just say, which most traders will look at 20 to 50 days out into the future. Okay. And so we're down here plotting that and we're saying, okay, so let's say we're down here. It's about, let's just say 30 days out into the future. What happens within this range? Does it all fit within the circle? That's a lot of directions, right? Well, there's approximately three. I'm looking at it correctly. There's up, there's sideways, and there's even a little bit of a moderate downward move that could occur. And when that does occur, the nice thing about this is with a short put, we're generally looking for, if we're holding above the strike price, to collect our max gain at expiration with a 3-directional move. 3 directions. As you can see within here, whatever that looks like, right? That's really the nice aspect of the short put, because you do have that neutral component. In fact, you have a little bit more than neutral, right? I mean, neutral is just kind of sideways, but if you had that down component, in fact, I'll put it in red here. This is down. I mean, this yellow arrow is down. But what some traders will do is they might sell puts, back to our yellow marker here. They might sell puts over here. So they might sell a put here. And so really, this is ultimately the key line that we're focused in on here. And I'll put an extra blue line next to it. In fact, I'll surround it. So that blue and yellow line right here is where we're anticipating or expecting prices to hold above that level by expiration. And that gives us the 3 process moves. So if I just take all these drawings, there's quite a bit in here. It's kind of hard to see when I do that, but if you go over here, we'll just say here's the trend, here's a pullback, and we're looking for the possibility of a bounce over here. But then again, we say, hey, it can go sideways, it can go down a little bit. We're trying to cover more bases by doing that. All we're simply doing is we're just selling that put maybe below another support level down here, a short put, minus P, right? One interesting aspect of this is that the higher the implied volatility, okay, so let's do this. I'm going to go ahead and just say IV up top, implied volatility. The higher that implied volatility is, and what's also connected to that may be, in fact, the beta. I know it's not used a lot, but it can be very, very interesting because a lot of times the IV and the beta almost have this two-way connection. I'll just spell it out. The beta, and we know what the beta is. Well, we can look at this again, but the implied volatility is that expected. Well, there's a historical implied volatility, which is kind of an expectation of the price of the stock over a period of time. Both of these, and the beta, of course, the beta refers to the volatility of the market. Referencing the market. The market has a beta of 1, and if you have a stock that has a beta that's higher than 1, well, then there's just expected more volatility. And both of these two scenarios right here, what they can do is they can create a scenario where there is just higher, put an upward arrow, higher premium. And that's the one thing I think all sellers of options really kind of circle around. They really like that. I mean, they love higher premium, because what does higher premium do? Let's look at it in this scenario right over here that I just had drawn for this exact situation. if we have higher premium on the puts themselves, it can give us more flexibility just because there's more there, right? We could potentially even go lower on these puts, right? And all else equal, try to uh, just give ourselves more room for really prices to be wrong. We could be wrong on these trades. I mean, it could go down further, but that higher premium from implied volatility, beta, from other, as we look at it, I mean, beta can influence it. We'll take a look at it, but it gives us more room for that price to move even down. So we're always okay with prices moving up. We'd be holding above the strike price. We're okay with it going sideways because we're selling below where the price of the stock is at. But now, if there's a higher premium, there's just more flexibility here to pull the short put a little bit lower. We could sell a put here instead, or sell a put here. So all else equal, it's not a guarantee of the direction of the trend. It's just with that higher premium, which is a function really of the implied volatility, and they can have higher betas, right? These stocks that have higher implied volatility just gives us more flexibility for that neutral to downside move. Okay. With that, so the next starting point is, because we're going to erase all this, I have to, but hopefully this made sense. What I want to do is, next thing is, okay, implied volatility. Well, folks, what is the big key reference point that we can look at in the market when we're talking about implied volatility? What is it that we would want to kind of reference? If we're looking at S&P 500 stocks, it starts with a V, and then it goes to I, and then there's an X. That'd be the VIX. So we might want to be greater than the VIX, greater than the VIX. So we can look at the VIX because the VIX is giving us that implied volatility of the S&P 500 collectively, and we want to be above that level oftentimes. We can look at those areas, and I've got a few stocks to look at there, but more than anything, I wanted to use the stock screener to help us get some of this information out. In other words, go through the betas, have that as a screen criteria in the stock hacker. We can have implied volatility to reference, but I also want to look at volume too, volume of the shares, because volume, liquidity of the underlying option, very, very important. Gregory, you got it. It's the VIX. Hello to you, Joe, and John joining us, but that's right. So let's do this. We're going to clear this off and get right into it. Put our charts back up, and we're going to take a look at the VIX next. So I'm just going to go over here. I'm going to type in the VIX. I might as well have it on my left-hand side. There it is. So where are we at in the VIX? Whoa. So we're all the way down here around 14 and change, right? 14. Now, sometimes the VIX can spike, and I've seen for years where I can come back here and look at long-term levels of support, and sometimes they'll bounce off there. But notice over here too, how long you can actually stay low at some of these lower points. I think that we're kind of adjoining right here. It's very, very close to this point right there. Very, very close, right? Along those same levels. See the dip? So we're just kind of holding right there. So we are kind of close. Now that's interesting, but when you have a lower VIX at 14, you might just not be getting a lot of premium too. And so you might be putting in a short put and putting that risk out there, but the return on that short put or the return on that potential risk is just not good enough, right? All else equal. We're actually looking at, if I said 35 or so, or even just 30, we're up here saying, it's almost like 2 times, right? So 14, about a times 2 number. It puts us about double the market. So that all else equal, we're capturing more premium, giving us the flexibility, possibly lower the put strikes to try to still collect a decent premium, or even keep them the same and collect even more premium. That's kind of what I wanted to do today with the stock hacker. You guys use the stock hacker much? I don't know. I found it very, very versatile. They're always adding new stuff to it as well. They really are. It's really quite helpful. You can see I have implied volatility columns over here. There are 2 different types of implied volatility. I'm going to talk about those in just a second. Before I do that, though, we'll go full screen here, and we shall go into the scan. Okay, key point. This is where we're at. Now, this is just the S&P 500 right now as it stands. When we're doing the stock hacker, you need to be here. So key tab, scan tab, sub tab, stock hacker right there. Now you could use the option hacker and look at specific options, But I'm figuring just looking at that front month, that current option, we can look at the implied volatility here as we take a look at the stock hacker itself. Okay, so let's narrow it down a little bit and I'll show you how we can do this. Now, a couple of these, depending upon where you run it during the day, it could show something of, it could be interesting based on the volume you're looking at. For example, in fact, I'm going to do that first and foremost. I'm going to start looking at a basket of companies that might be companies that have had, earnings over a stretch of time. They've had some, specific criteria to be on the S&P 500. Just looking at short puts on these companies. So let's do this. Add filter. Okay, and we can go into, actually the study is interesting. No, yeah, the study is good because you could go down here under the study under volume, and we're looking at average volume. Now I could run volume right now, like over 1 million shares, but the thing is, it's 12:15 roughly Mountain Time. There's still about left in the trading day, and some of these stocks are going to be above 1 million shares by the end of the day. So if I were to run this in the morning, there's going to be a lot of a million share plus traded on average stocks that would never pop up if we're just looking at it on a day-to-day basis. So that's where this average volume is really, really helpful. And so it's just going to throw a 50-period moving average on volume, and then it says, hey, make sure we're over 1 million shares over that time frame. And what I'm going to do is I'm just going to say, we could go I might just start off at 2 million. But I mean, million's decent. Actually, I'll just keep it at 1 million. We'll just go from there. But I mean, you can notice, like, if I just look at volume here, you've got so many that are well over 2 million. In fact, let's just see where 1 million's at. See this? We're collecting basically almost, well, okay, maybe that's half of the companies have already had 1 million today. So, yeah, anyways, as long as you have liquidity, you're good. And that's really, I mean, you're trying to get liquidity, a good spread between the bid and the ask price. So there we go. There's 1 million shares. Now, the next thing I wanted to do was go over here and add in the stock here. We have a implied volatility column, which is nice. I'm going to explain the differences between a couple of these here, just so you understand it. But, if we come down here, there's beta that we can screen through. And remember what we said about the beta of the market? It's a 1. So if it's greater than 1, it's more volatile than the market. And that can be okay. It might not be okay because volatility obviously cuts in both directions. It can be volatile to the upside, it can be volatile to the downside. Now, if you're incorporating, though, into that technical analysis, like the trend, price patterns, indicators, and I know I've seen a few of you guys in here, you guys do, I've seen indicators, you brought them up before, and I know you use those, and they can be very, very interesting, right? So those components could, a trader could anticipate that it might be upside volatility. If everything's pointing that direction, they might believe that it can continue that way versus downside. So there are things we can work with to help us in that regard. All right. What I want to do first, just out of the blue, I'm going to run this right now and just get a list of these companies at 1 million. Now, what do we have? We have to actually knocked off on average. You can see about 100 companies that didn't quite make 1 million on average volume. Now, I did not touch the beta yet. I can touch the beta, and I might do that in just a second. But I want to highlight something over here for you right now. Let me do this. By the way, what else can impact that implied volatility? What's the big one? It is earnings. Earnings can impact that. So we can check over here and just see if there are earnings announcements potentially coming up or not. We might see earnings or earnings indications. Normally those are in blue, right? But we don't have a lot near term. And so it's an interesting time to look at these short puts as well. So let's do this. First things first, we've got a list of our 400 companies in the S&P 500 that meet our volume criteria. I'm going to click over here. Actually, before we do that, let's just try a beta of 1. So it's either at least equal to the market, if not more volatile. Click. There we go. 203. Look how much that chopped out. So much. It's incredible. I mean, now we're down to 233, right? So with these two, we're less than half of the S&P 500. But now are you starting to recognize some of these names in here? Just these 2 basic criteria. This one, I said, this is not used a lot, but I think it can be very, very helpful. It looks like the max over here is a 3.2 that came up on our list. In the S&P 500, that's pretty high. But like say, for example, Uber, that's an interesting example. It's exactly twice as volatile over the time frames that the beta is measured, right? Twice as volatile as the S&P 500. Well, look at the implied volatility. See how that could be an interesting reference here for us? 42. What was the VIX? Approximately 14-ish, right in that range. Substantially higher. What could that mean? Well, it could mean, a lot of things, but it's likely, just higher potential premium to capture, giving us the flexibility of maybe selling puts a little bit lower and still being able to collect a decent amount, or whatever that's referred to as a decent amount, right? Whatever a trader might be looking at there. Now, look at this up here too. Tesla, applied volatility, wow, 74. Okay. It's 50% more volatile than the market. I think it might be actually sometimes, if it starts to really spike a lot or there's a lot of movement, implied volatility can outpace the beta because the beta is generally a longer term measure as opposed to implied volatility. It can be. There's some variation there, but I've read points on that as well. Okay, so let me do this first. I'm gonna go ahead and highlight this first column and just say super micro. Whoa, it's got a super high implied volatility, about 120. The beta is clearly there. This, that's a company I don't even recognize. AMTM, Momentum. So that's up there too. What we're doing right now is we're just kind of cross-referencing and saying we're greater than one or greater, which is this screen, by the way. So we've helped ourselves out there. And we're looking through this list. Let's look at a few of these, like right now. SMCI. Okay, let's get some comparables so we can understand this first. Oh, I am in a 1 year. Okay, fine. Let's go over here. SMCI. Boom. All right, so there you have it. SMCI. Now, as we look at SMCI, obviously SMCI is down, and maybe we don't like that, and that's not going to work for a short put. A very, very important point. The trajectory of the trend is lower. You filled this gap over here, and sometimes when you fill the gap, like right there, prices will then are free to kind of move back down or back up, whatever the case might be. And there you go. By the way, there's earnings coming up too. So there's a lot of volatility and it's been to the downside. So this might not be one, but I just want to show you, like say, for example, this is a $30 stock, $33 currently. Let's just look at the trade tab right now and look at that 30-day out, that January monthly here. We're looking at short puts. Wow. 120 implied volatility. So I was just looking at this and saying, like, wow. This is just like the case in point I was making. Oh, shoot. Here we go. Let's go back to 30. I'll just say 30. Okay, look at this. I'm going all the way down to 26. I'm still getting in the dollar range at 26. Now we're at 33. This is 26. It's a low price stock. There might be a lot of things going on behind the scenes. This first example was just to kind of illustrate maybe some of the scenarios that work, but maybe ultimately with the stock it doesn't work. But hey, we'll use this example because it's a pretty good references to what we could see with higher implied volatility anyway. So look at the 26 over here. So if we were looking at a short put on the 26, it's down a ways. It's all the way down about here. But looking at this chart, you can see that the stock can move quite a bit. So it doesn't look that far away, actually, by the way the stock's been moving. There's your 26. Where's the 20? 20's all the way down here. Boy, this thing's volatile. So this is where the implied volatility in the chart, you can kind of see like 26, it's like you're not even getting much room there, even though it's like several dollars lower. So it's a good comparison, right, to look at. Now, if implied volatility was closer to the VIX, let's use this feature right now to explore kind of what that price might be. I'm going to be using the theoretical price. The theoretical price uses different option Greeks and just sort of indications as to, making an estimation of where the price of the option would be relative to what the stock does. But what I'm going to do right now is I'm just going to keep the date the same, and I'm going to drop this implied volatility, folks. I'm going to drop this. Wow. I'm going to give you a sense of how much this is actually adding to the mix here. So I'm going to drop this 105. So we're getting as close to the 15, like where the S&P 500 is. I'm actually going to drop this 105. So let me just do this right now. Let me try that one more time. Let me just, I have to kind of peek over here and just take a look at this. So minus 105. Boom. Oh, well, let's see. 105%. Oh, okay. Well, that is okay. Let me just try this. Minus 50. Okay. Well, I've cut it down quite a bit. Minus 100. I don't know why that one didn't work. It just wiped out everything. Yeah, the 100s didn't work, except for a few of these. But down here, it's saying these are absolutely worthless. Even knocking off 100, the 26 is worth nothing. So if I knock off 100, we'll just keep it at 20. So it's like a 20 implied volatility. Look what you've got. I mean, you barely have it. This 33 is worth like a penny. It's really quite low relative to what we're at right now. But you can see the impact that that's having. Just trying to put it even close to where the VIX was at. I'm going to zero this back out. We're good to go. Cool. Okay, so I just want to zero that out and just to kind of show you the impact that that is having. In fact, let me just point this out too. I always keep, this is kind of my customized set I use because, you know, what's ultimately controlling or really influencing, I should say, influencing the price of these options here. Well, we know as we look at the implied volatility column over here, and then we compare that with the Vega Greek. And for every 1% increase or decrease in the implied volatility in IV, okay, that you're seeing over here, that's going to influence the stock, the option price by the amount, and that's every 1%, sorry, 1% up or down. 1% up or down, gosh, that's hard to read, sorry. 1% plus or minus, okay, the IV right there will influence the a 1% change will influence the option by the amount of the Vegas. So let's just look at this 30 right here. Shoot, if it moves up 1%, what do we have? Or it moves down 1%. It's going to drop this value by 3 cents. But if it moves down a tremendous amount, like we were showing, like 100 or whatever, what does that do? It basically zeroes it out. Like that's not even worth anything. So you can see the impact of it right there. And the Vega Greek is how, you know, that influences the price of the option based upon the implied volatility. So just I wanted to make sure you had that down. I think it's an important component that's built into the theoretical model as we were looking at there. All right. So having said that, that was just kind of an example I want to show you because I think it's important. Now we're just going to hit some trades as we go through here at this point in time. Let's look at a few of these. Like here is Dexcom down here. DXCM. I want to look at Intel as well, but DXCM. Now DXCM has been down quite a bit. It's been in this lower range, very, very low. Now, you know, some people might say, you know, is there a support level? Because when we're dealing with short puts, of course, you might want to have a short term, at least the trend going up, and we are getting higher highs and higher lows. That's a big drop. Sometimes these can take time to kind of, you know, I should say form along the bottom. If it's like a rounded bottom, it can take a long time. But guess what? That's exactly what a short put seller would be totally fine with. If it takes time, that's theta decay, right? That's potential, well, unrealized income coming in over a period of time if it doesn't go below the strike price and it's not, you know, it's not assigned to us. So, like say for example, here is a key support level I would say down here. It's kind of extreme. I want to look at the downside one first, but what does this, like for example, 65 or 67.50 look like that has this key level longer term support down here? What did those options look like on the Januaries, right? What can we expect here? Because again, prices could go up, sideways, or down. We're trying to collect that. So let's go back to our trade tab and we'll see it right now. So there is Dexcom. There's your 65. So it's like 85 to 95. Open interest is really good. These are all in the thousands. That's what we would anticipate with what we did. We really tried to find higher betas with, you know, good volume too. We've got that. There's the spread. It's a dime. But you can see that right there. Now, right here, I'm looking at the implied volatility is about 56%, clearly above that approximate 14% of the VIX. Are we going down a little ways? We are. As a matter of fact, as we use the delta now, we'll shift to the delta Greek. And remember that what the delta does, the delta influences the price of the option differently than the Vega. It looks at a 1% increase, not in implied volatility, but in the underlying stock. So a $1 increase, I'm sorry, not 1%, a $1 increase in the underlying stock. So if it goes up $1, right, the delta would influence the option by the amount of the delta. In this case, we're dealing with puts, so it would go down. So clearly that helps us in our favor, right? Price of the stock goes up. What does that do to the option? It decreases it, all else equal, and that's beneficial. But then there's the theta, the time decay. Sometimes, when you get the higher implied volatility, there's more premium there, and there is simply more premium to erode, and those thetas are just they're just gonna be bigger because they have to erode what's remaining, the option amount. So you're getting that theta decay. Beauty of the theta decay, again, it's time decay 7 days a week. That includes holidays, folks. That always makes the option sellers, all else equal, happy, right? Because that's happening every single, not the option buyer, but the option seller. So look at these. And by the way, this is also the delta then, I'll connect as an approximation too. Here's 13. There's like a 13% chance or whatever, the way you look at it, that the price of the stock would go below 70 or below 65. It's an estimate as well. So that's only 25%. This is 13%. Wow. All the way down to 60. That's according to what we're saying in terms of what the delta can tell us, like a 35% estimate of us going below 65 by expiration. And that doesn't include that big support down there either. The possibility of a rounded bottom, right, on the chart. So I wanted to really kind of show that it can be used for neutral trades, and that would mean longer term rounded bottoms, just trying to collect that over 32 days. So I think a lot of traders, though, will look at a 40, I should say 0.2 to 0.4 delta. That 65 was all the way down to 13. But I think that's kind of what some of the flexibility you might get with a higher implied volatility. You can still capture some premium here, but at a lower strike price. And so that could, reduce the chances of, it getting assigned because prices might not be going below the 65 by expiration. So I wanted to look at that right there. I'm going to do this. I'm going to go ahead and throw in, because there is some support, quite a bit of support over here at the 70. And as you can see, notice over here with me, we did make a high over here, did we not? Look at that. We made a high. So we did break into new high range. Somebody who's looking at this, maybe they just want to speculate on a one contract right there on the put. And again, if the price of the stock does close below 70 by expiration, or, it can be assigned at any time, but then the chances are significantly higher, right, that we would be assigned shares of stock. So you want to be mindful of that. It's still giving you that flexibility, that downside move. Where are we at? 76.37, so a little over $6 before you get down below that strike. But this is important because it's important to know that, with one standard put options contract, if there is an assignment, we'd be buying 100 shares of stock. Now, cool thing is we still get to keep our premium that we're selling. If we do the 70 or the 65, we still get to keep that amount. I was looking at the 70 as an example. And that could lower our total cost on the trade, perhaps, right? The total cost, if you look at it, because you're getting that premium too. So even if there is an assignment and you're buying 100 shares at 70, your total cost could be lower because, well, you still get to keep the premium. All right. But before I do this, let's see if there are any questions. And Barb's doing an awesome job. Appreciate it, Barb. I think might be a good chance just to pause and just to state too, folks, if you haven't already, please subscribe. Bottom right-hand corner of the screen, just hit that subscribe button. So easy to do. And we'd love to have you on board. We have over 130,000 subscribers right now. We'd love to add you to this group if you like this kind of content. And if you do, be sure and smash that like button. I'd really appreciate it. Let's see, next up, let's hit it. I don't think we have any surveys yet, so we're good there for this class. All right, so let's do it. Let's put that on right now, and we'll walk through that. So there is our 70 right now. I'm going to go ahead and just hit confirm, and let's read it. So we've got the max profit. We know that it's our credit less any commissions. There's your break-even price. Again, that's below 70, right? So the break-even is 68.10 because it's factoring in the receiving those that premium. Margin requirement 16, a little over 1600, 1660. Put that in there. Okay, and we'll see how this unfolds. It did get past earnings. We don't have any earnings through that time frame. Looks like the next earnings generally is about into February. This was a January option, so outside of the earnings range, I think many of you might be good with that too. All right, let's go back to our list here. I did want to take a look at Intel. Intel has gotten hit. It's kind of a longer term one as well. Now, case in point, look over here with Intel. If we had been selling puts below this level, would we have been making more money, the same money, or less money if the stock would have gone like this and we're just selling puts? Short answer is if we didn't get assigned and we're selling puts below that the price of the stock, it's just likely that we wouldn't, much more likely that we're not going to get assigned by expiration, then it would be the same. And that's what I'm getting. I try to drive that home, that neutral aspect, right? Prices are going down. There was that gap there, and prices kind of have been consolidating here. Actually, if prices had gone up this much, we probably wouldn't have been selling puts at the same level. But there could have been, just this is all in hindsight, obviously, but coming through here and looking at it, there could be several months where it's holding above the strike price where you're just trying to collect the max gain on a short put. Really a key difference, obviously, huge difference compared to just buying stock outright. You know what I mean? Correct? Because you got to buy low and sell high. That's an example. I'm not going to look at it right now, but I wanted to show you because sometimes, hey, you think, oh, it's just going to be here, and the other side is it's just going to hold here, but the other side is that maybe as an option buyer, I'm okay owning stock at a lower price, particularly if I can just keep collecting shares. Now, the other aspect I wanted to point out real quick is, if you do get assigned shares, what could you do? What's the other part of this class that we talk about? That would be the covered calls. So all of a sudden you own 100 shares of stock because the price of stock went lower. I have 100 shares of stock. Well, that's kind of nice because in a sense, because that's exactly the number of shares you need to at least sell one covered call. Right? And so therefore you could flip around and kind of do the option wheel and then sell more premium. If you do get called away because prices go up, you could turn around and then sell the short put again and just kind of create sort of an income strategy by using covered calls and short puts. Wanted to throw that out there because that can work for some individuals that are okay being assigned at lower prices, right? I mean, maybe they're just comfortable. They think, gosh, there's value here, is what I'm getting at. All right. I was trying to say that. There's value here, but I never got to it. I mean, that might be the perception, right? It's a low price. Anyways, we're going to move away from low price. We're going to move into something like a Google over here, okay, that does have a move that just broke above highs and kind of tested here. Now, it's getting close to 200. Sometimes there's resistance at 200. But even though prices have broken higher, what's another scenario we could look at? Well, as long as it holds like a short put could, above, a short put, it holds above a strike price. I'm just going to kind of put in some strike levels here that could be of interest, maybe above a support level that you feel comfortable with. It's okay if you've already missed the move, as long as you think it's going to hold above that level, it could still possibly be, a short put. This is just an example. Whatever stock we're looking at. In other words, price of the stock comes over here. It's already broken higher, whatever it is. This looks kind of a little bit like Google here. But, as Alphabet's broken above that level, whatever the case is, I mean, if you're selling here, maybe you missed the bounce off the bottom. Maybe you missed the exact breakout, which was missed over here. But is there not possibly still some areas of support that we could be selling that short put at? Yeah, there could be. There could be some areas, and that was the point I wanted to look at. So looking at Google, quite strong, and I want to kind of hit both aspects because I know many of you look for strength of the upside, strength of the trend. Let's just take a look at these now and see where we're at. In fact, I want to just drop this down here because this did come up in our list. The beta is just about over 1, and the implied volatility, we're going to take a look at it right now, is 30. So we said what we're looking at initially, the 30, maybe double the VIX, for example, double the VIX. So let's look at it. I'm going to narrow these down just a little bit. Let's go to 20. There we go. Okay. So now let's come back to our deltas and see that 20 to, well, this is kind of in there, the 185, very, very close. It's 18. Look what you have. So there is your theta, a reference over here to open interest in the thousands. That's a lot of traders will look for that. Volume up top. We should be getting some pretty good spreads likely with that kind of, volume, etc. And open interest. Look at that. 5-cent spreads on the 185. So let's look at these right now. Let's look at the 185 and the 190. 185 puts us kind of in that area I was pointing at initially, right all the way down there. Now, with the implied volatility being as high as it is, and that's, we looked at these. This is a stock hacker company. I just have to go through and find it, but it's there. It meets the criteria that we were after. And so looking at this, this takes us like what we said before, the expectation, or some people might say, hey, there's only an 18% chance that it might go down below here, or an estimate, 18% estimate that it would go below this level. So it's really quite low. Again, you're just saying, hey, I'm just looking to try to collect income over the next 32 days or less, or 80% of that income. So you can break down and look at one of these. I'm going to go a little further one out. I'm going to try this one for now, the 185. Let's look at this one. We'll put this in as a paper money trade in our paper portfolio here. But there you go. So there's the break even. Max profit is 154. Now, the buying power effect is 1460, 4600. As I mentioned earlier, Barb, in the classes that she's taught, there are ways by using a short put vertical where you're buying a put also to really help narrow down that margin requirement. I mean, substantially, right? They can do that by buying a long put, which is further down in the strike. But I went ahead and put this on, and there you go. All right. Sometimes, people do have a lot of, let's say, for example, additional funds in their account, and they wanted to just utilize it this way with a short put. There you go. So there's that one. I want to look at Meta as well. I think we're just about out of time. But lastly, I'll leave this with you guys to take a look at. So here's another one that's been quite strong. Now, it's quite expensive. Again, could be kind of more of those short put vertical scenarios possibly because the price is so high. But we're going to take a look at it anyways and just see what we've got here. Higher highs, higher lows. How are we doing on the beta? 135. Okay. How about implied volatility above the 30% that we talked about? So it's going to meet our stock hacker screen as well. And let's take a look just while we've got it. Wow, you can go all the way down here. So the 590 and 585 are really kind of in the 20 delta range. Let's take a look at those two. 585, 590. Wow, look at that. 500s, and you've got like a dime spreads, 15 cents to a dime. That's incredible. 590 here. 585 about here. That was about an 18 delta. Do you see that right there? Through the next 32 days. And by the way, what do we have over the next 32 days, folks? We actually have some holidays. Quick question for you. Is there a time decay effect over holidays? Christmas, New Year's, some longer, weekends like that, right? Holiday type weekends. Answer to that is yes. Yes, that could be also an effect. I'm gonna go ahead and just draw that 585 very quickly so we could see it, but there you go. Your break even here, the 560, and then your margin requirement's quite high, but the max gain is about 560. I'll go ahead and throw that through right now. All right. So holding it through some holidays, and that was one of the things I want to talk about too with the theta. But that could work in our favor. All else equal. Everything's an all else equal, right? As we narrow down a particular, specific delta or whatever it might be. I should say a Greek. All right, everybody. There is a subscribe. Oh, I'm sorry, Barb mentioned that. Yeah, if you wouldn't mind subscribing, no survey today. Thanks so much, Barb, for your help with the chat. It was great to be with you all. Really appreciate the comments, questions going back and forth amongst the group. All right, everybody. Have a great rest of the day.